I like to get in when they are really hugely discounted. So that's the strategy. Now, I'm going to be doing some videos in the future about some strategies that I'm using. Right now, I'm trading and also doing covered call strategies. Basically, in this case, I would hold 100 shares of that position. For example, let's say NVIDIA 100 shares. And what that means is that I would open the position by selling that contract, which is equivalent of 100 shares. And let's say for a strike price that is higher, let's say it's at 115, I would say, let's say if I choose 130 and I get the premium, let's say $300, let's say for 2 weeks. What it means is if NVIDIA reaches the 2 weeks expire and the price is below 130, I get to keep the premium, $300, right? So let's say it's at 120, right? What it means is I get to hold the shares, but I get paid that money. Now, if it drops, what I can also do is I can roll it forward, right? Let's say now it's at 120. So what I would do is I would buy back that one contract at the same strike price and expiry date, right? And by that time, the decay would have kicked in, right? Let's say maybe a day before the 2 week period. So what that means is I would then get the premium, right? And then open another position by selling another covered call, selling an option contract for, let's say, the next 2 weeks